All right, good morning, everybody. Made it back to another week. So we should start to see a little increased participation now into the uh, later part of the year. The next set of holidays that really get involved with the liquidity is like Thanksgiving and then the Christmas holidays. So from here, it's an uphill. We got the bill behind us. So all eyes now are on tariff talk. Of course, the negotiating tactics of the current administration are pretty well known now. So it's all taco. August 1 seems to be the new current deadline. So at least it defines a line in the sand. And we're supposed to get data out this week on the number of countries and the names of those countries who are close to finalizing a deal. I heard India and Vietnam were on that list, but when it comes to other names, that's all we hear is and others. So we don't really have you know, the fine details on what others. But the other negotiating tactic, the chaos that they were utilizing in the first part of the year, they seem to really be done with that at this point. So the reason that comes into effect is from the bond plays and their effect on the market. So really the next big thing beyond the tariffs is CPI next week, not this week. So a little bit of a reprieve. We're still topped out and in a range. So GTFO got to break the box, get out of the range, and that'll define the next leg higher and lower. It is worth considering if you've got short options on in the futures, say like a short call or a short put, what the margin will do if you get challenged in that short call or short put. So just be mindful of the idea that, on the MES, for an example, you may have only needed 5,000 in margin to sell a naked put, which is fantastic because if you try to sell a naked put in SPY or the SPX, you would need a fortune. But to do it on the MES, 5,000 or so, not bad. If you get challenged, however, that could increase by another 50%. So instead of 5, you might need 7,500. Or if we really see some volatility, it could straight up double from 5,000 to 10,000 in margin. So just be aware of that, right? You don't want to get a margin call. It's not fun. And because it's naked, the simplest way to eliminate a margin call if you do get one is just buy a long option. So if you're holding a short put and you get a margin call of an additional $5,000 and you're thinking, shoot, I don't have that. Buy a put, bro. Right? Now you've got a spread and you're not even on margin anymore. Now you're just holding a spread. You'll still probably end up with a loss, right? But it would be a loss defined by the width of the spread, not having to, buy back a short put or increase your margin limit. We are just sort of drifting, waiting for something. This is always a dangerous time in the market when the market is in this sort of give me a reason mode. We don't have much big economic data this week outside of waiting on headlines, and that can get fun. After all the hype with that bill, we finally got it done, and they'd already priced in the win, so we didn't get much push after it was finalized. The put wall was rolled down even further. If you guys remember the last time we met, the put wall had already begun a roll lower. That distance has increased. It's now down at 55.50. They're just, getting things out of the way. Don't let this distance freak you out at this point, right? Just remember that the machine will search for the next level and it'll call that the put wall. It does not necessarily mean that they are positioning the market to go to 55.50, right? We don't know if this is a 1 day situation or, it's going to stick through the week. So don't let this 1 day print, freak you out. Having said that, they really did get it out of the way. If they are looking for anything that might have held them back in a move to the downside, we certainly don't have the put wall to worry about anymore. On the other hand, we do still have the volatility trigger and zero gamma. And that's another key piece. We're still well above both of those, and we won't get through them easily, right? So even if you are positioned to remain neutral or long, and that position gets challenged, these two are going to help slow things down a little bit. Right now, one of the key characteristics I'm looking for to increase maybe some neutral short plays as opposed to neutral long would be a break of the 4-period daily moving average. I know it's a very small moving average. It's easy to overlook, and moving averages in general are not trade triggers to get in or to get out, but they do help define the analysis and what we're looking for next. Just like when we run fib plays, once we breach a level and we can close below it, it opens the door to the next level. So closing underneath the 4 opens the 10. Closing underneath the 10 opens the 20, and closing underneath the 20 opens the 50. Kind of get the idea, right? Each one sets us up for the next level lower. At the moment, we haven't even touched that 4, let alone gotten below it and closed below it. You can see we got there and we went below a number of times. That's not what we're looking for, right? We're looking for a close below to open the door. And then, of course, if we can get a 410 cross, that would be the white line crossing the blue line, then that would be a surge signal. And if it's headed to the downside, then it would be a bearish surge as opposed to an upside play. For an example, back here, when we had the white cross the blue, first you get price crossing both. It outruns both at a considerable distance, which drags the white line sharply higher, crosses the 10, and then they all begin to fan out with the 20. You have that fork pattern. That was a bull surge. So it ain't broke, right? We still don't have a short trigger. Volume's a little light this morning, all things considered, but we've got to earn it back from the light volume of the holidays, short day, short week. So we're looking to see this slowly increase as we get through July and into August. And we've got a very narrow IB at this point, IB initial balance. All things considered, we really haven't done much of anything at this point. We're basically at a negative 0.25%. The average daily range is 67 points. And if we move our average daily range today, we would hit one of these two red lines. And to do that, we would need to break out of the previous day's price action. So we need an inside day breakout. And right now, don't really see that on the table yet. $62.93 cog line is this week's pivot point. The weekly pivot last week, we opened up gapped above it by a considerable amount, and we had a hard time most of the week driving farther away from it. And on the one day that we really gave it a good shot, we weren't able to keep it. We just gave it all back, came back in again. This week, we're opening within the channel of that weekly pivot. We're there. So, we were really handicapped last week on how far we could go to the upside because we had already given most of it away by the time we opened up. This week, we're within the channel. It's like we're starting at go and have plenty of room within the week for 4.5%, 5% move to the downside, 2.5% to 3% move to the upside. And we would look at that kind of a run and not even consider it out of line. We wouldn't be overbought or overextended or oversold. It wouldn't be too much. We don't have an MDP for the day, a missed daily pivot, since we've already hit it multiple times. And all things considered, the channel today is relatively wide, which implies that even if we do get a breakout, it's not likely to stick. You can really see the work, back here 2.5 weeks of just putting in all of that time and effort and then the expansion out of it. A little bit of a top here and some work that we put in now has defined this level that we've got to get through. So this high volume node, 63.25 area with a high of like 63.32 cog line, something like that. Yeah, really close. Gotta love those cog lines. That does define the line in the sand to the upside that we not only have to get through, but close above. So if we can get a close above the 30 level cog line, then it opens the door for 63.50, 6,400, or at least 63.92. But that's a significant high volume node overhead that we're going to have to deal with from last week. And we're sitting in the shallow spot. So if we continue to drift lower, we've got 62.50. And below that, 61.50. We'll be playing hopscotch at 100 marker levels all the way back down. Ten-day, 30-minute volume profile with TPO. Both of the points of control are lined up. We still have a really wide distribution, but as we get through the week, we're expecting everything to tighten up quite a bit. And unless we break to the downside, this should be the width of our distribution as we get into the later part of the week. Of course, it can expand if we break that 32 level and continue to the upside, and or if we come back down and start putting some prints in to the downside. But we've got some structure 6150, 6250. As I was just mentioning on the other chart, we're going to be hopping at 100-point levels. We should go through the roundies relatively easy. So 6,200, you see it's really shallow. We'll just drop through it. 6,100, same thing. We'll be hitting the 50s. At this point, we just don't have any bearish bias other than, we've been long. And that's a tricky bias to hold. To say that you're bearish just because we've been bullish, that's not a very good position to be in. What's that old phrase? The markets can stay irrational longer than you can stay solvent. Something like that. The VPOC that we're looking at here for Friday isn't really a good one to use. When we try to factor in holidays and short days, you're better off just combining everything. But if we do mark out what we have, then we have this VPOC from Thursday, and then we do have this one from Friday, and that would cause a bit of a channel. And it gives us something to focus on for the box, right? When we think about getting out of the box and where that box may be, I think this is a good box to focus on. So I'm not going to be focused on them from a point of control having been hit or not hit per se. That I don't think they really have much value for that. But they do define our current cage and what we need to get through. And I like both of those levels since they are points of control. They are the highest volume levels for their day. And we should see activity on the dome at those levels to really reinforce what we are seeing in price as we get into those levels. So say we break our own Globex high, we run to challenge this point of control from Thursday, we should see trading activity in the dome, the tape, time and sales, all of that to really confirm what we're going to do at that level, or vice versa if we hit the downside. 63.23 on the upside and 62.85 on the downside. GTFO, we have to get out of that box. And then, of course, that's just the front run. We would still need to break Thursday's high for a good, clean continuation, or Friday's low for a continuation to the downside. New week, new box. So one of the things we want to start with is, how does this box compare with, we don't want last week. We want a box that has the same amount of days in it as the week that we're going to have, right? Last week was a short week. This week is not a short week. So we don't want to compare it to last week. So we'll go back 2 weeks. We can see that this week is much shorter than the week we had 2 weeks ago. At first blush, this may appear like there's less volatility this week, right? The width of this range is derived from two data points. One is volatility and one is time. Well, the amount of time that we have in our current week is the same amount of time that we had in this week back here. It's a 5-day week, right? So it's not time that's different. It has to be volatility. When there's lower volatility, the box is narrower, and this week is a more narrow box than this week. So less volatility. Sounds good, but it doesn't always work that way. Events can be volatility suppressing, like FOMC, for an example, is a volatility suppressing event. As we get closer and closer into an FOMC week, the markets will begin to go sideways as they wait on that data before they make a new decision. And that can make us go sideways. And we'll see it priced in before that event gets here. So either there's a really big event this week that the market is concerned about, which is why we have this narrow range, or there's just less volatility. The CPI that I was talking about at the beginning of the show, it's next week. It's not this week. And that's the next big economic data point. So it's not one of our own data points doing this. It could be data coming out of Japan or Europe, or it could be the deadline with the tariffs. Either way, it doesn't really feel like we're in a low volatility environment, right? Which is why it, at first blush, it may seem like, hey, we got less volatility being priced in. Yeah, no, it really seems like the market's just pricing in a hurry up and wait mode while we get some data that it's looking for, some clarity, very likely clarity on the tariffs. We're still more than 4% above the 10-week. That's considered the mean or fair price or true price. There's a lot of different ways to define that level, but we're overbought if you consider it from that perspective. And we have been, right, for a long time. I don't really like to consider it from a level of overbought. It gives new traders bad ideas about what price should do next. But the 10-week, being above it or below it, is often defined as the health of the market that you're looking at. And if you're above the 10-week, you're in a relatively healthy market. That's a good starting point. But at this level, we have to begin to worry that we've gone too far, too fast, and we'll begin to mean revert. If we look back at how often we've been at this level or higher, we've been higher than this before, farther away from the 10-week than we are right now. It doesn't usually stick. You can see a lot of times we get above that and we just come right back in again. Or maybe it lasts a few days before we come back in again. Coming back in is inevitable. We know we're going to come back in. The question becomes how fast. There's been situations where one day we're 4% above the 10-week and the next day we're 1% below it in a single day, single shot. That's fast. Then there's other periods in time where we just work our way back down a little bit at a time. So, of course, we never know what we're going to get, but we do want to keep our eye on how far away from the 10-week we are. And if we do begin making moves to the downside, the 10-week makes for a really nice target when you're doing monthly lottos. Say you want to go out and buy a put for August. See how cheap they are for a target on the 10-week. I still like what Spot Gamma says, though. If you're looking for a short in the S&P or the NASDAQ, maybe target SMH. Its options are a lot cheaper, and SMH is going to respond in a negative way, just like the S&P and the NASDAQ would. So if you're looking for a short in the indexes, probably do it cheaper with an SMH play. Looking at the 10-day, we're still more than 1.25% above. We're just maintaining this range. It's a good, safe, healthy place to be in. We're not overbought. We're not overextended. We haven't traveled too far, too fast, and it doesn't owe us any sort of pullback on that time frame. So we're just in a good, healthy place. But it doesn't leave us much room to the upside without us getting into a position where we're a bit too stretched out. So we're not overbought here, but another 2% to the upside would certainly start to put us in that overbought state. So it's not to say that we can't go higher. It would just take a lot of effort to go higher from here. Looking at things that are down this morning, the benchmark I use this early is 0.5%. So we're looking at things that are up or things that are down at least 0.5%. Right now, Bitcoin, the Mag 7, China, precious metals are all down at least 0.5%. Bonds are almost there. Chips are almost there. Uranium is moving in a negative way that's just not, it's not there yet. Flipping it over and looking at what's moved to the upside, at least 0.5%. We got some China moving up, or at least is positive. Maybe it's giving it back, considering how many of the China ones are down. Otherwise, we got nothing up 0.5% this morning. Take a look at it from TrendSpider. We've got pot stocks. You don't want a rally day based on pot stocks. It's not what we want. So yeah, we got pot stocks and ag, DBA, agriculture, and the VIX. Crude is moving in the right direction. It's not quite there yet, but it is up. There was some talk about OPEC this morning, and maybe they're going to relax things a little bit. Banks are up a little, not yet enough. $1.02 is up a little, but not enough. So a whole lot of waiting with a lot of things that are down. But if we look at what's in the middle, not up in 0.5% and not down 0.5%, that's where the bulk of the watch list is at this morning. Sitting in a neutral place, looking for guidance and clarity, and it's just not really making a move in either direction. Which is what we need to be doing too at this point, looking for guidance and avoiding headlines that are little flashes of the pan, right, where we get a 2-minute move and then we're just right back where we were again. So big data next week. This week, so far, we've got no indication that we're even going to make it to the edges of the box. And if we do get to those edges, it's more than likely that we're going to get a 111 or a 123 reversal and come right back in again while we wait for something, wait for an excuse at this point. Watch the headlines. Maybe shop around a little bit, see if there's another nation's economic event big enough to shake us loose. I looked around, I didn't see anything. That doesn't solve the problem. We got to get out of the box. So 63.32 or 62.70. Get out of that range and we're good. So what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.